Welcome to this EY video on the exposure draft on regulatory assets and regulatory liabilities, which was published in January 2021. My name is Vincent van Kaloen, and I'm a senior manager with the global IFRS team at EY in London. In this video, we will provide an overview of the key elements of the guidance proposed by the IASB in the exposure draft, or ED. I'm joined by Giorgio Acunzo. Giorgio is an associate partner based in Rome. He is a member of several global SMGs and is also a member of the IASB's consultative group for rate regulation and EFRAG's rate regulated activities working group. Giorgio, welcome and thank you for joining us today.
Thanks, Vincent. I'm glad to be here.
Now, the IASB has been working on the topic of rate regulation for many years. Already before many countries adopted IFRS, so more than 15 years ago, questions were being asked about whether entities could recognize regulatory balances resulting from rate regulation. Why is this so important, Giorgio?
Well, Vincent, rate regulation can significantly affect the amounts and timing of an entity's revenues, profits, and cash flows by specifying how much compensation an entity is entitled to charge customers for goods or services supplied in a period, and critically, when the entity can include that compensation in the regulated rates charged. IFRS standards have not addressed this issue, and as a result, many rate-regulated entities applying IFRS do not recognize regulatory balances as assets or liabilities in their financial statements, making it difficult for users to understand how rate regulation affects these entities' financial performance, financial position, and cash flows. With this ED, the IASB intends to fill this gap in the IFRS guidance by proposing a new standard that addresses the scope, recognition, measurement, presentation, and disclosure of regulatory assets and regulatory liabilities. Rate-regulated entities are therefore expected to be significantly affected throughout their financial statements.
Giorgio, you mentioned rate-regulated entities. I think much like insurers and the insurance standard, entities outside the power and utilities sector do not expect this standard to affect them. However, it is important to stress that the proposals of the ED apply to all entities. Three conditions are proposed to determine the scope of the standard. The first is that the entity must be party to a regulatory agreement. The second is that the regulatory agreement determines the regulated rate the entity charges for the goods or services it supplies to customers. And finally, the third is that a part of the total allowed compensation for goods or services supplied in one period is charged to customers through the regulated rates for goods or services supplied in a different period. So this can be either past or future. Does this mean we could expect regulatory assets and liabilities appearing where perhaps we may not have expected them?
Yes, you're indeed correct, Vincent. Although we believe entities in the power and utility sector should be on high alert for any development in this project, rate regulation can come in many forms, including a contractual licensing agreement between an entity and a regulator, a service concession arrangement, also known as a public-private partnership, or a set of rights and obligations specified by the statute, legislation, or regulations. It's therefore important that all entities carefully assess the proposals and their potential impact on their financial statements.
Indeed, good advice there, Giorgio. Now let's have a look at a simple example to highlight how the proposals in the ED may impact an entity's financial statements. In this example, an entity is party to a regulatory agreement that entitles it to recover the input costs it incurs in supplying goods to customers. The regulated rates for year 1 are set to recover estimated input costs of 100. However, the actual input costs for year 1 totaled 120. The regulatory agreement allows the entity to recover the additional 20 input costs that were under-recovered in year 1 by an increase in the regulated rates they will charge customers for goods to be supplied in year 2. Like in year 1, the regulated rates for year 2 are set to recover estimated input costs of 100 plus the input costs under recovered in year 1. That is the 20, so there will be a total of 120. Actual input costs for year 2 are 100. Giorgio, how does the ED propose we account for these transactions?
Well, Vincent, the table in the top right-hand corner aligns the concerns with the approach to this issue under current IFRS standards. Without the proposals in the ED, investors may conclude that the entity underperformed in year 1 and then overperformed in year 2. This is because the revenue in year 1 does not include the compensation of 20 that relates to goods supplied in that year. However, the revenue in year 2 does not include the compensation of 20 that relates to goods supplied in year 1. If an entity were to apply the proposals in the ED, it would account for regulatory income of 20 in year 1 to reflect compensation for goods supplied in year 1, but which will be included in the regulated rates charged to customers in year 2. It would recognize a regulatory assets of 20 in year 1 for the right to increase the regulated rates in year 2. The entity would subsequently unwind the regulatory assets by recognizing a regulatory expense of 20 in year 2 to reflect amounts in the regulated rates charged and recognizing revenue in year 2 that provide compensation for goods already supplied in year 1. It should be noted that the 20 added to the regulated rates in year 2 is part of the total allowed compensation for the goods supplied in year 1, not for those supplied in year 2. The total allowed compensation for the goods supplied to customer in year 1 and year 2 are 120 and 100 respectively.
That's great, Giorgio. It's important to note that the proposals require an entity to account for the right or obligation arising from each individual difference in timing as a separate unit of account. However, if rights and/or obligations arising from the same regulatory agreement have similar expiry patterns and are subject to similar risks, they may be treated as arising from the same individual difference in timing. Significant changes to processes and procedures may be needed to allow entities to track and report on each individual difference in timing, or to demonstrate that they can be aggregated. Like all new standards, there is an emphasis on the disclosure requirements in the ED. Giorgio, what are the proposals here?
Well, Vincent, the overall disclosure objective is for an entity to disclose in the notes information about regulatory income, regulatory expense, regulatory assets, and regulatory liabilities. This, along with the other information in the financial statements, should enable users to understand two things. Firstly, the relationship between an entity's revenue and expenses as completely as would have been possible if the total allowed compensation for the goods or services supplied had been fully reflected in revenue in the period in which the entity supplied those goods or services. And secondly, the entity's regulatory assets and regulatory liabilities at the end of the reporting period.
Thanks, Giorgio. To make this more understandable, the ED proposes three specific disclosure objectives. The first objective is that an entity shall disclose information that enables users to understand how the entity's financial performance was affected, because part of the total allowed compensation for the goods or services supplied in one period was or will be included in determining the regulated rates and hence included in revenue for goods or services supplied in a different period. To achieve this objective, an entity shall disclose in the notes the components of regulatory income or regulatory expense mentioned on this slide. Giorgio, what's the second objective?
The second objective is to disclose information that enables users to understand the entity's regulatory assets and regulatory liabilities at the end of the reporting period. Understanding this will provide insights into how regulatory assets and regulatory liabilities will affect the amount, timing, and uncertainty of the entity's future cash flows. Vincent, what is the third objective?
Well, Giorgio, the third and also final disclosure objective is that an entity shall disclose information that enables users to understand any changes in regulatory assets and regulatory liabilities that were not a consequence of regulatory income or regulatory expense. To achieve this objective, an entity shall disclose in the notes a reconciliation from the opening to the closing carrying amounts of regulatory assets and regulatory liabilities. Giorgio, what are the next steps with this ED?
Well, Vincent, as with all EDs, the proposals are now subject to consultation with comments due by 30 June 2021. We encourage stakeholders to provide feedback to the IASB on the proposals in the ED to contribute to the further development of this important project.
Thanks, Giorgio. With this, we've come to the end of this EY video on the exposure draft on regulatory assets and regulatory liabilities. If you are interested in more detail, please refer to the IFRS development publication on this issue, which you can find on our website at ey.com/IFRS. Thank you for watching. I'm Vincent van Kaloen, and we will bring you more insights on this and many more IFRS developments in our future videos.